This is a chart of the S&P 500's returns and its drawdowns. I went back to 1957, plotted every year's returns and its max drawdown. We're going to go over this chart, why this is one of the most important charts to understand as a long-term investor, and talk through the question of, when should I buy? Let's do this. Hi, I'm Christoph Marzek. I've been a professional trader and investor for almost 20 years, and I'm on a mission to help you become a better trader, a better investor, and ultimately have a better life. All right, let's dig in to the S&P 500's drawdowns charts. Okay, this is something every long-term investor needs to be aware of. Okay, I really want to make this concrete for you guys. Okay, so what I did is we're gonna go over this dashboard. I created this dashboard. This is going to be available for you to use. Okay, I am going to share this link. You can go ahead around and play around with it. On the left panel side, you'll show some toggles here. I'm gonna describe what these are. So the focus year, this is a year where you can choose to look into a little bit more closely into what year of the S&P 500 returns. You can see the changes here. I'll go over that a little bit. Also, this toggle of how many years you want to show on this chart. Okay. Some back-end knowledge for you. I took the daily close only. I'm only obviously looking at January 1st to December 31st. I'm running the peak resets every calendar year, obviously, and the peak date, obviously, is before the trough date, okay? So what this is spitting out is this chart. So when you choose, let's say, the full gamut, I went back to 1957, which, by the way, I chose 1957 because that's when the S&P 500 officially was launched. Before that, it was only 90 stocks, so I wanted to use the most accurate data. So I could go farther back, but for the sake of accuracy, I went with all 500 stocks only, all right? When you go back to 957, this is what it looks like. So what you're looking at, this big chart here, is the returns are the bars, and the orange dots are the drawdowns for each year. So you can go ahead around and play around with this. You can look at, for example, 2017, pretty juicy year, right? We only had a 2.8% drawdown with a nice 18.42% returns. I should also mention, this is just price returns. This does not include dividend. This does not include dividend reinvestment. So things were a little bit juicier than even what they're showing here. Going on with just being able to use this, we'll talk about these other platforms later. This down here is where you can change your focus year. For example, that 2017 year, let's say you want to say, well, what exactly did that look like from a drawdown perspective? You can plot that and see what the drawdowns look like throughout the year. Grab another year here, one that's probably more memorable, 2020. This is what drawdowns look like throughout the year of 2020, okay? Now, let's go over the findings, okay? But before we get started, I want to share a brief story. 10 years ago, I met with a financial advisor, okay? And he presented me a real estate deal, something in the ballpark of, I think it was like a 2 to 4 year hold period, new construction build, et cetera, et cetera. And the expected IRR was 11% return a year, okay? And my question for him, because I thought it was kind of risky, a new build, 11% return. My question was, sir, given the risk, why wouldn't I just go into the S&P 500? Okay, and his answer is ingrained in my brain like no other, and I want you guys to really listen carefully here. His answer was the word sentiment, okay? And I thought, what do you mean by sentiment? And he said, well, when you're investing in the S&P 500, okay, you have to live through price changes. You have to live through seeing your account balance fluctuating. You have to live through FOMO. You have to live through the emotional swings, essentially, is what he was saying. And I'm paraphrasing here. The emotional swings of seeing a print, not only daily, monthly, weekly, but down to the millisecond, right? And this is and he was pointing to the real estate deal. This is better because you don't have to deal with that. All right. And I thought that was kind of interesting, that the reason why somebody would take more risk is simply to shield themselves, to block themselves, to not have to deal with seeing prices change. Okay. That's the whole point of why I'm making this video. I want you, as a long-term investor, to be prepared for that sentiment of those changes, that emotion of the changes. And what do we see when we look at this chart? Okay, this goes back to 1957. We see that every single year there is a drawdown. Okay, you as a long-term investor have to be prepared that every single year your account will fluctuate. And because of that, okay, because you are going to stomach this, you will be rewarded better than the real estate deal at 11%. Maybe there's real estate deals that are higher that compensate for that risk. But, and I'm not just talking about real estate deal, private equity deals, other deals, okay? Like, compared to those, your real risk is overcoming the emotion behind drawdowns, all right? And again, you guys are going to have access to this. You can play with it. You can toy around with like, oh, look at 2008. Holy cow, right? 2009. Yikes. Big drawdown there. Decent green bar, right? Now, the opportunistic-minded person that you are, and I'm with you on this, Christoph, it'd be kind of nice in 1987 to buy the low and ultimately ride it to a break-even low. And even though this green bar is so tiny, if you could buy the low, you made 33.5% that year, right? Of course. That sounds juicy. Of course. That's what the whole philosophy of buying the dip is. And we'll talk more about buying the dip and whether it's a good idea or not in this video and other videos. But the question becomes, how can you possibly predict this, right? And I know some of you are like, dude, Christoph, just look at the dashed line here. It's hovering around the 10 to 25% dip area, right? And yeah, I agree with you. You know me, I'm not a MACD guy. But if we did plot a moving average, I didn't do it on purpose, but if we did plot a moving average, yeah, it's probably dancing around the negative 18% line, right? Maybe a little bit up, maybe negative 15. And yes, you could sit around and wait for the negative 15%. However, that goes back to the sentiment argument. However, why would you be doing that and possibly giving up on all the years and all the time where you're on the sidelines where it hasn't happened yet, right? And let's go, I mean, goodness, the past, since 08, right? We're at 15 years here. Yikes. You had 3 chances. Okay, 3 chances, and you missed out on a lot. Okay, so then the question, my natural trader mind goes in and says, well, is there a time period during the year where we can at least expect potential more volatility? Potentially there's a max drawdown? Aha, I got you here. Let's scroll down. And again, you guys are going to have access to this. Full screen. What I did here is the dip timing map. I couldn't think of a better name, so I apologize. When during the year did each one of those max drawdowns occur? And hang on, I got to switch this back to the full because this does auto update, okay? Based on what you're displaying. When did the dips occur? Let's go through this. This is interesting. January, 0. And you might say, well, that means I'm long Jan 1, baby. I'm not even going to deal with a dip. That could be true. However, most likely there were dips. Just the max dip, the max drawdown didn't occur in January. And if you think about the math and the chronology, that makes sense, right? We didn't have enough time from the start of the year for the S&P 500 to appreciate, to allow the biggest dip. Okay? Pay attention to that. January, February, similar argument. It's too early in the year where we didn't have enough time to see the max, right? Interestingly enough, March is a little bit more active than I thought. Now, what is March? 2020, COVID. The other big, by the way, also how big the circles are is how big of a drawdown it was, okay? 2009, we all remember, if you remember, S&P 500 went to 666. We were really not knocking on heaven's door, if you will, all right? 666, and we bounced. I remember that. April, a little bit more active than I thought that I would have seen. Again, this is the max dip for any particular year. May is light. June, a little bit more active. This one, actually, I find kind of interesting. Okay, we're 7 months into the year. We're at the halfway point. And July only holds 2 prints of being the max dip. 1984 and 2010. Okay, that's interesting. A lot of people on summer vacation. Picks up a little bit in August, but again, I'd call that average. September, a little bit. And now I know what you guys are thinking, and I'm thinking the same thing. There seems to be a little bit of a cluster in October, November, a little bit of December. What can we theorize about that? I can tell you one thing. I got kids. Summer vacation ends. School restarts. Hey, kids, going back to school. And suddenly the credit card bills from the camps and that trip to France and Spain and wherever else people go comes due, right? Things get a little thin after summer break. Have you seen the camp prices? No one's talking about camp prices. Everyone's talking about groceries, whatever, clothes. Have you seen the camp prices? It can't be part of the CPI. The camp prices cannot be part of CPI. All right, sorry, a little tangent there on the camp prices. But nevertheless, there seems to be a little bit of a cluster here in Q4, I'll admit, okay? Now, could it be because we had a whole year of appreciation? You know, it's because it's the opposite of what Jan and February is. It's towards the end of the year, so therefore we have a little bit more to fall from a high? Possibly. That could possibly be the reason. Could there be a little bit more oomph to this observation pre-Christmas? Got to go buy some gifts. Maybe I'll sell some stock to pay for it, which, by the way, I'm going to have a whole nother video on how you should never sell stock. I'm going to talk about it and still get liquidity. Okay. Stay tuned, folks. There's so much stuff here. It's going to be bananas. All right. So, again, I'm going to leave you. I'm not going to tell you. I'm filming this in July. I'm not going to tell you you should wait till Q4. Yeah, because of this cluster. No. I'm here to show you objective data, and this is what this is. Okay, the last part here of the chart is you can download the data yourself. You can, again, this is the focus year. If you want to look at what 2016 looked like, here's what 2016 drawdown chart looked like. All right, so let's conclude here for a moment. Let's summarize, right? First of all, this tool is available. I'll have it in the description. It's sitting there ready for you to use. Here's what I want. Here's the big takeaway that I want you to be aware of. And this is related to my sentiment story. One needs to be aware of the dip and being aware of its certainty. That's the big one here. It's certainty, okay? Waiting for the dip potentially could be costly. We're going to talk about that. You're missing out on that time. If you told me, Christoph, I'm just going to buy Q4, dude. Look at the data. How many Q4s where it wasn't the max drawdown? And how many of those years did you miss out on some upside? And those are the years that are important. Staying invested is important. When you go long term, stay in. That's the difference maker. And we're going to talk about why that's so hard, by the way. And the big reason why it's so hard is for the following question. Ask yourself as an investor, not when should I buy? Okay, that's a big question. People ask me all the time, Christoph, when should I buy, dude? When should I buy? That's the wrong question. The correct question is, when do you have to sell? If you're like, Christoph, I am thinking I need some liquidity in the next 18 months. When should I buy? What do you mean? 18 months isn't a long time. That's a totally different discussion on even buying the S&P 500, right? If you told me, Christoph, I'm looking to be retired in 30 years. Okay. Then the time to buy is now, by the way. But 18 months or something less than 4 or 5 years, totally different question. So the whole discussion, the whole focus of your investment strategy becomes different when you say, when do I have to sell? Versus when should I buy? Okay. We're going to talk about that a little bit more in another video. I hope you guys got tons of value from this. I find it interesting. Please use the tool. I await your comments. I'd be curious to see what you guys come up with. What you want me to change. If I have time, I will be able to. And we'll go from there. I look forward to the next one. Have a great day. Thanks.